Hey traders, I wanted to touch on a few more markets because this was a pretty big day today. So anytime you have a big, they call them distribution days, and I can tell without even looking at the volume that it was a big down day on heavy volume. That's what they call distribution day. Um, but everything's connected. So a lot of times, if markets are going to make a big change in direction, especially global macro longer term, everything's connected. So what'll happen is you'll start to see markets change and break big levels and break our TMS across multiple markets. So you can look at gold, you can look at treasuries, you can look at um, U.S. stocks, you can look at dollar yen, obviously dollar index, you can look at the euro. When everything kind of starts to change direction, then you know that this might be the start of a bigger picture move. And I don't see that yet, but let's just look at a few things. So today, I already touched. I'm going to do this video. Um, well, I just did this video and I went out about stocks. I don't really want to cover them too much. So here, I talked about this level is pretty big, 2320. This is the TMS, the bands. You guys understand that. So if we break that, then the model calls for much lower, a bigger pullback. The VIX I talked about in that other video. You guys can check it out. What I really wanted to cover was treasuries. So the 10 years, 10 years been very quiet, and it's been in no man's land that we talk about in the chart. You know, here when you get above the bands, this is kind of no man's land. You get above the bands between here and the 200 is just kind of a difficult place on the chart. And so we got above the bands. If you were short, really needed to play some defense and or just get flat. And then we had this move up, and then it's just been a boring trade. But today, look at the size of this candle versus all of these candles, right? This is a real money candle, and we're above the bands, right? So to me, this is a really big pivot. If we get above here, we get above the 200, then we should easily test the pi line. But then, just like the euro is focused on the Trump highs, we could see treasuries take a move back towards here. All right, so it's always if then, meaning first you got to get above here in the 200, then you possibly test pi. Then if you get above there, you focus on this level. So those are the three spots. Now, how you play it from there matters. So it's pretty much. I don't want to be negative, but the people that make these calls that are saying, "Oh yeah, based on today, blah blah blah, Trump this, Trump that," blah, they make up this big story and then make a big grandiose call that treasuries are going to go back to below, back to 2%, or we're going to retest. That's not really helpful to make that call when you got to get through three different walls before you get there. That's just not the right way to trade. The better way to trade is say, okay, what are you going to do at this level? Are you going to wait for it to break out and then go long? Are you going to go long right now and get heavy right into the highs and then it fails and you lose money? So just making a call like that without really a process is not helpful. What we want to do is say, okay, there's two ways to play this. I still think that stocks have not broken down long term. They haven't. They haven't based on the trend. We know how to define the trend, guys, the highs and lows, and they haven't broken. So until that happens, and until US GDP, which is currently doing this, starts to roll over and do this, you're not going to get me to be bullish on treasuries for the long term. Right? US GDP went from something like 3.3% year over year. I was bullish treasuries this whole way down. Then we went to like 1.3 or maybe 1.1% growth. And then after Trump election, this all picked right up. And all right, this is still on an upswing. That's as far as the economy. Now that's growth. That's the growth side. Inflation, there isn't any real inflation. So it's just bond yields are being dominated by Lately, this move was a lot of saber rattling, right? North Korea, Syria stuff. There was a lot of that. But this is an intermediate term move. We're talking about this trend. You can see the pie line. This is the long-term trend, and that's not going to change really unless growth really starts to turn. Now, the bond market may be pricing in a slowdown now, but it's too early to tell. And so for me, this is what I'm saying, for us to start to get long-term bullish, you're going to need to get me above here. And even if you get me above here, I'm going to hate the fact that I don't want to get long with this high right above the market. So I'm actually going to play a short up against this level and then wait and see. If it cracks the 200, which everybody's going to have on their chart, right? Everybody's going to have the 200. Nobody has our pie line. That's my little discovery. It's simple, but trust me, nobody has that on their chart. So this is a level everybody will have, and it's coming right into this resistance. So I want to play it short because we're still in a long-term bear market, and I still have a growth accelerating view on the US GDP. And stocks have not broken down. Stocks have not broken down from their higher lows, and S&Ps already went over that. So I'm going to play a course short and then longer term. And if I'm wrong and we get above here, so be it. I'll stop out. We'll play defense. But this is my risk. It's very small, right? And then I might even short it again here. But this is small risk compared to what might be available on the downside. So anyway, that's what I'm thinking about treasuries. And again, this is showing you that everything is connected. If bonds break this level, if S&Ps break that 2320 level I was talking about in the prior video, all right, if the VIX starts to make higher highs, and we're already seeing the euro change direction, but it's still going to test probably the November election highs, which is that 113 level. So it still hasn't, all these markets have not changed from their long-term direction, which has been bearish treasuries, bullish stocks, bearish the euro, bullish the dollar. Everything global macro is still in place. We just need to be aware of these intermediate term pivots. So this was one. This is a big one now. But I'm going to play it on the short side. That's longer term. Now, it doesn't mean that I'm not going to play. I said this in the room. It doesn't mean I won't play day trade more aggressive. So maybe I'll just sell 1, 2, 3, 4. Maybe I'll get 5 contracts short in 10s. But then I'm going to come in every day and on ultras and look to go long if we get the right 15-minute and 30-minute cycle set up, and I'll get long 2, 3, 5 ultras, and then maybe my 10-year position's out of the money by 10 ticks that day, but I make 3 times that on ultras. That's how I'll day trade ultras. And then if and when we do fail here on ultras, and then not only do we have the 10-year going down, and we'll play this on the short side day trade on the long end, that's where we're really going to make our alpha. So that's the fractal nature of the model. That's playing different durations that I teach you guys. That's the art of the size. That's the art of getting into our risk management. All that stuff, you guys know, only comes from being on, basically going through the full access team and going through the full the full training on the model. All right, but anyway, guys, I just wanted to give that update, a little bit more thorough when you look at it across bonds and stocks. So we'll see what tomorrow brings. Again, we need more follow through than just one day, and then we need to see how we finish out the week. All right, guys, enjoy the rest of your evening, and talk to you in the morning.